So let's talk about education planning today. What are some of the options we have when we are thinking about saving some money for our kids? We have, I think one of the most popular one that you probably have heard is the 529 plans. They are very, very popular. If you go on Google or whatnot and type in education planning, I think that's the first option you will see, 529 plans. The second one, not that popular, is Coverdell, and rarely you will see somebody using their Roth IRA for education planning. And lastly, you will see some people pitching insurance products as education planning. So I'm going to start with 529, and then I'll go to Coverdell, Roth, and insurance and see what each one of those have. However, I'm just going to do some basic planning today here, but to do a little bit more specific to your needs, to your kids, I think it's best to set up a consultation appointment and kind of discuss in person. But I'm going to try to share as much information as I can on today's webinar. So 529s are extremely popular. And they're popular because Congress wants parents to set up 529 plans and fund those education plans, because obviously they don't want that many kids to be going on financial aid, in simple words. What are some of the advantages, the key reason you want to do 529? Number one is you can put a lot of money in them. You can put up to $80,000 into a 529 plan. There is no income limitation. You could be making $300,000, $500,000. You can still spend your money on 529 plans. You can change the beneficiary anytime you like. So let's say if you have a kid, they didn't go to school, you want to change the beneficiary, go ahead. There's no problem. It's all good to go. How do the 529 plans work? So I think most of you guys are probably already familiar with Roth 401k or Roth IRA. How does the Roth works? Basically, you put money as an after-tax contribution, so you don't take any deduction on your tax return, and then the money grows tax-free, and you can take it out for your retirement purpose, and you're good to go. 529 plans are designed similarly, except you use the money for educational purposes. So the contributions are obviously not deductible, so it's not you're not going to get an immediate tax benefit out of these. However, you may qualify for some state tax benefit depending upon which state you're in. Now, I think as of right now, about 30 states offer some sort of tax deduction or tax credit, but not every state. So you want to be careful as to which state you are in, because you might not be able to take advantage of that. There are no annual contribution limits. However, contribution in excess of $18,000, and I'm recording this in 2024, so that's the uh, gift tax exclusion limit, $18,000. So if you gift more than $18,000, that would count against your lifetime estate and gift tax exemption. But you can do 18,000, your spouse can do 18,000, so that's okay. Other thing you want to know is that each state also has an aggregate contribution limit for 529 plans that can range anywhere between $235,000 to $550,000. But I think most of you are okay. That doesn't really bother you that much, right? Now, assets held in 529 plans, those assets are seen in a friendly way to your FAFSA application. So maybe those of you guys who already have kids in college, or maybe you went to college here, you know what I'm talking about. It's known as free application for federal student aid. So if you want to see what you qualify for, you apply and you get the number. But when you go apply for FAFSA, they also ask what kind of assets do you have. So money that you have in 529 plan for federal aid is seen as a favorable point of view. They don't ding you too much for having too much income in there. The good thing is, in the recent years, after the Secures Act, IRS has also expanded the way you can use the 529 funds. Before you could only use it for your college, but now you can even use it for your school. So those of you guys are sending your kids to maybe private school, this is something interesting. You can there's a $10,000 annual limit that you can withdraw for paying your tuition expense. I know many schools are expensive, maybe $1,500, $2,000 tuition, but hey, $10,000 is still pretty good. So that's still not bad. You can also use 529 funds to pay your student loan. Once again, there's a limit on that, $10,000 annual limit. So no more than that. What about withdrawal? Well, if you withdraw the funds for known qualified expenses, and I'm going to talk about what is qualified, what is not qualified just in a second. But if you withdraw the funds, you will have to pay an income tax on that growth, and you will pay withdrawal penalty of 10% on those earnings. So not the initial contribution, but the earnings you will pay 10% penalty on. Now, student can choose to go public university or a private university, so that doesn't matter, and they can choose to go to any state. The only thing is that institution has to qualify. So how do you find out if they qualify? Well, you go to Department of Education's website and you can look that up. So what are qualified expenses? Well, obviously tuition fees paid to these qualified institutions is definitely good. So you can use that for that. For books, for materials, you're good with that. Room and board, you can do that. Computers, you can do that. One thing, if you're using it for room and board, you have to be enrolled at least part-time. So you got to be going to school at least part-time. Internet access, you can use the funds for that. If you have special need kids, they get a little bit of credit for their needs, so that's good. There are some things that you cannot use the funds for. For example, you cannot use the funds for college application and testing fees. I know a lot of kids pay a lot of, at least a couple $1,000, I think, just in those two things alone. Unfortunately, 529 plans don't cover that. Then obviously you want to go see the university, you want to go visit the schools, they don't cover that. When you're at the college, you have to buy health insurance, they don't cover that. Extracurricular activities, they don't cover that. So pretty much any expense that is not considered a qualified educational expense is not covered. Now, for example, some things that you might think might not qualify may actually qualify. Like, for example, there are some institutions that you might think that would not qualify otherwise. I'm just trying to think a couple of them that can come to my mind, but I don't remember right now. But always check with the institution, see if that institution qualify for 529 expenses, and go to Department of Education and verify that, because sometimes you might think that they don't qualify, but they do qualify, and vice versa. Now, what happens to your 529 funds if you don't use them? Can you withdraw them? Can you get them out? Yeah, of course you can withdraw them, but like I said, you will end up paying 10% penalty, and that's not cool. And obviously, you put the money with after-tax dollars, so there's no tax there. But any earnings that you got in the account, they will be taxed. But the better option is you can assign a beneficiary, but the beneficiary has to be another family member. So, or yourself, by the way. So it could be spouse, could be son, daughter-in-law, foster child, adopted child, grandchild, you know. So any of those, and like I said, you can also you can make yourself a beneficiary, go back to school, do your master's, PhD, and use it that way. So that's 529 plans. Now, one thing before we leave this topic, I want to remind everyone is there are a lot of different 529 plans out there. A lot of them. Different states have different 529 plans. The way they grow is different. Some 529 plans are based on buying the tuition fees in advance. So basically, what you're really buying is inflation protection. Some 529 plans grow at a certain rate. So you get all kind of numbers. I think those numbers will be obvious for you and you'll be able to figure that out pretty fast. One thing that you are going to have a hard time with is figuring out the cost of those 529 plans. I mean, when it comes to cost, I personally use Vanguard, although I'm not really a big fan of 529 plans, but I still have some funds in there. So I do like to use Vanguard for that purpose because I know that their fees is usually lower than other places. So one thing I do want to point out is figure out what's the fees. All right. So let's talk about Coverdell. Now, Coverdell is very similar to 529. It's still after tax money, so you don't really get any tax deduction on it. You can use the funds for qualified educational expenses, just like 529. Um, Similar rule applies for what is qualified, what is not qualified. Similar, not exactly same. There are minor differences, but for the most practical purposes, very same. Now, what are some of the problems with this? One of the biggest issue with Coverdell is that you can only contribute $2,000 per beneficiary per year. Beneficiaries do not have to be related. Remember 529, they have to be related, but beneficiaries in this case don't have to be related. So uncle can go ahead and contribute, aunties can contribute. So you can have your family members contribute, I guess, and quickly build up your Coverdell plan if that's what you're planning to do. Beneficiaries must be under the age of 18 when the Coverdell is opened on their behalf. Along with that, contribution of $2,000 a year can only be made until the date of their 18th birthday, not the year they turn 18. So 18th birthday, they're done. Donors cannot make more than 120. There's an annual gross limit, right? Once again, why does the gross limit have? Because Congress doesn't really want you to use Coverdell plan. They want you to use 529 plan. So what they put a limit there. They say, look, the single has to be $110,000. If you're making more than $110,000, you cannot put money in Coverdell, or $220,000 if you're married filing jointly. So I think most people are still able to contribute, so that it's not that bad. And if you make more than that, then there are some strategy, there are some ways that we can make that work. But I'm not going to talk about that right now. That's a topic for a private conversation. So if you are in that bracket, then we can have the discussion on that. What can you do with the leftover money? Well, what they do is they say, look, you can change the beneficiary just like 529, but it must be by the time your original beneficiary turns 30. And after that, what do you have to do? You have to move the money back into the 529 plan. Once again, they want you to use 529 plans. Your contributions will never be taxed or penalized because you paid it after tax. But since they were made with after tax dollars, at least you don't have to worry about that. But any earnings on your investments will be subject to income tax. And obviously, if you withdraw it, then you pay that 10% penalty on top of that. Now, what I like instead of that is focus on Roth. I mean, you can have Roth account for your kids. If you have maybe some sort of LLC, maybe you have a side hustle, maybe you have some business going on. We want to set up something that can give some income to your kids. And using that income, we would prefer to have them put the money in Roth. I think that's probably one of the best strategies out there. And the reason being is because Roth going to grow tax free, and you can always take the contribution out and still let the income grow until their retirement. So it's a beautiful strategy. So what I recommend my clients is maximize the Roth if you can, then go put money in Coverdell, and then think about 529 plans, and lastly, insurance plans. Because see, insurance is designed for long term, not for 10 years, 15 years for going to college. So I don't really like that strategy. So my personal point of view is that you maximize your Roth, you maximize your Coverdell, and then you go to 529, and then you go to insurance, and more than likely probably not even go the insurance route anyways. But in some cases, I guess that can make sense if you're putting a lot of money into it all at once. That can happen. So I shouldn't really say it's a bad strategy, because you never know. There's always an exception. Maybe somebody set up an insurance plan and they put in $1 million 15 years ago, and that account is growing very well. So maybe that's not that bad of a strategy. But I think I'm talking in general terms. So everything I discuss, by the way, is all generic. I still recommend that people kind of set up a consultation and tell us what is their individual situation. That way we can suggest them how should we structure all these assets, how should we structure these transactions that can produce the maximum tax benefit for you. But I think that these are the basics for 529 and Coverdell plans. I hope that makes sense to you. If you have questions, you know how to get hold of me. Just send me a question on WhatsApp, and I'll try to answer that either in one of our groups, or I will make a video and post it online for you. Thank you so much for staying with me, and I'll look forward to meeting you in our next financial discussion call. It happens every 2 weeks. So if you are not part of it, I would strongly suggest that you join that call. Just go to Tax Code Advisors and you can sign up for that call right there. I'll see you there.